Hello and welcome to my show, The Awakening, here on WGSN-DB, the Going Bold and Going Solo networks. The information and opinions expressed on this show are just that, the opinions of the individual speaking based on their individual personal experiences. They are not intended to diagnose and do not constitute professional advice or recommendations. My name's Tina Huggins. I'm your divorce coach specialist, divorce consultant, restorative family mediator, and conflictual co-parenting coach. And today's show is named Mortgage Talk with George. I'm going to try to get his last name right, Agban.
Got it
Okay.
right.
So very good. So George has decades of experience in finances and specialized focus on mortgage for the last 7 years. He prides himself on I'm gonna talk over my tongue. He prides himself on delivering customized lending solutions to meet the unique needs of individuals and businesses. As a trusted mortgage consultant, George assists clients with both residential and commercial financing, offering options such as SBA loans, equipment financing, business cash advances, and real estate funding. So I am so happy to have you on here. You're the first person that we've actually talked about mortgages with, George. So thank you for being here.
No, thank you for inviting me. Pleasure's all mine.
And George and I were talking beforehand, and this is George's first podcast. So he
Yes.
gets to get all of his little butterflies out in the very
Yep,
beginning
yep.
part. So I was asking him how to pronounce his name, and that's how come we were saying that. And so I found out something about you is that I was pretty sure your last name was Egyptian, but I wasn't positive. And so that's really cool that you explained that. So that was kind of fun.
Yeah.
So with my clients, all of my clients, in fact, I just talked with one today that was talking about his mortgage and the refinancing of his house and how he was going to go about doing all of that. And I can say that all of my clients at some point are going to deal with a mortgage lender because they're either going to have to refinance or they're going to have to buy a new home. And then I just literally purchased a new home just over a week ago. And so I still have the mortgage lending aspect just very fresh in my head. So when we talk about that stuff, like, are you able to help people refinance their home?
Definitely, definitely. I mean, the way I'm looking at it is when you step in on the home ownership, you're stepping in on the biggest investment in your life.
Right,
Either if
right.
you're going to buy that house, or if you're going to use it as a second home, if you can afford to buy another home, or if you're going to use it as an investment. It's considered an investment. So the first thing is you need to think about it is look at the loan officer, or I call myself a mortgage advisor because I advise with my client on what is the best option for them. We're all familiar with FHA loans and the conventional loans. This is only two. We're not talking about hundreds of loans that's out there that it's fit every criteria and every goal that the client might need. So that's why it's better for them to go and discuss what's their goal, what's the need is with the lender or the mortgage lender, and they will decide, okay, what is the best option for them to get into the house. Because lending is, like you said, there's a lot of variables on that. And if you're not familiar with it, you're going to go and stuck with, okay, I'm going to go to the bank and get me a loan. Well, the bank is going to give you a certain type of loans. That's what they have. But if you
Mhm.
go and work with an advisor or a broker or a wholesale, that means he already have a multitude of loans. He can fit you on the right product that can fit your needs.
Okay, so then are you one of those people that have a multitude of types of loans then?
That's exactly my specialty is there's a lot of people that specialize in certain type of loans, that's the niche. Mine is I'm looking for what is the type products that I can have my clients fit their need with that. If somebody comes in and said, okay, I'm a first time home buyer. Okay, what you want to buy this house for? For how long? how much down payment are you looking for? How much you will need to have the payment, the monthly payment will look like. They have to break it down because if you're looking at it as we said, buying a house, it's financial burden if you're not getting the right decision to make. There's a lot of variables that when we decided on buying a house. A lot of people decide, I'm not ready. Okay, how do you decide if you're not ready? Well, I don't have a down payment. Okay, how much you're thinking you need to down payment? I need 20%. Okay, 20%, that's considered like the average or the minimum that you're looking for without paying something we call it mortgage insurance. But do you know that you can have a loan for 3% or even 3.5% if you go into the FHA? Or there is a lender that they can give you that 3%, so you don't have to pay down payment. And somebody might say, well, but I don't have the money for closing costs. Okay, there is lenders can give you those money for the closing costs as well. You might get those from the seller to help you out as a seller concession. So you might end up as you're not paying that much out of pocket when you're buying a home. So the best thing is go and discuss it with your mortgage broker to decide for you is what is the best option for you. You might say, well, I'm ready. I have the money. I have everything. And then you find out that your credit is not up to what it's looking for is to give you the good rate. We can go with a 500 credit score. Well, normally 620 is kind of the minimum. Yes, 500 is going to give you some, but it's going to cost you most as far as down payment. It can cost you most as far as interest rate. Doesn't mean that the interest rate right now we're talking about within hovering between the lowest 7 to the highest 6%. But you might not get that rate. Why? I'm not putting enough down payment. I don't have the good credit score. I don't have a reserve. That's another thing that we're looking for. How much money you have in the bank sitting aside. So there's a lot of variables that comes in. So the best thing is just go ahead and sit with your loan officer, discuss with what is your goals, and then be able to assist them with all this information and put them in the path to where to be, okay, now you became ready as far as home ownership.
Mm-hmm. Mm-hmm. Yeah, I know that I recently sold my house in Arkansas, and so I had a chunk of cash that I used to put down on this current house that I just bought. And a lot of people, they don't see, I think, they weigh out rent versus, mortgage, and they don't see, like in this case, I had this large amount of money that I got from the sale of my home. And to me, it needed to be reinvested. I needed to invest it and I needed a home. So it was like the perfect thing for me to go and do. And then I'm self-employed, so I had to jump through hoop after hoop after hoop to get my mortgage. And in my case, yes, you would be like the mortgage person I deal with, but then you have underwriters, correct, that we have to deal with. So
That's
can you
correct.
explain what an underwriter is?
Okay. Underwriter is the person that will assess the risk in the file. So what does that mean? We have a lot of multitude of lenders, which is considered an investor. So when somebody comes in, if I come into you and Tina tell you, okay, I would like to borrow $10,000 from you. Okay, I met George a few weeks ago, and I'm gonna give him $10,000. But I want to be sure, I want to guarantee that he's gonna pay me this money back. So what is the first thing they're gonna ask? Are you continuing with your current job? Do I see consistency that you are working? Have you have history of paying your debts on time? How long do you have that history? Do you have savings sitting in the bank? All that give me criteria of that borrower where they are. If somebody that's jumping on jobs, but he doesn't have consistency as far as what you're doing, working carpenter here one day, jumping in and going to another driver, then another day, and don't have consistency of that income. So that tell me as a lender or as an investor is this is a risk associated with that. Or somebody with a credit score. That's what the credit report that we run is going to tell me. So what we're looking for is underwriter is the one that's going to sit and decide what is that file. Is it high risk? to the lender or not. So our job, because we're on the front, is before we send it to the underwriter, is we consider ourselves an underwriter as well. We're not technically in details of the whole underwriting of the file, but we underwrite it in a way that we know that where is points or the red flags in the file that we're going to point it out to the underwriter. We're not going to hide it. You cannot hide something like that because you don't want to have surprises in the file. But what we'll do is we highlight those to the underwriter, and the same token is we're going to go and tell them, okay, where is something we call it compensating factor, meaning what is good on that file or in a positive way that can cover that risk factor. So the underwriter is the one who's going to go and point out and see, okay, would the borrower be able to pay the mortgage and the property that's already you are buying is appraised with the same amount of the loan? So that's what the underwriter is, kind of like on the fence, try to protect the investors or the lenders from getting a loan that's considered shabby. That means, okay, guess what? That borrower is not going to pay that. So now we're going to go into the foreclosure and defaults and all this bad things happen to them. So they don't want to do that. So that's why they are the one that kind of push the file and present it to them.
Okay,
And that,
so in the case with my clients that are having to refinance their mortgage, what does that look like for them?
refinancing is a different than purchase. Why? Because refinancing is we already have a loan already in place, and we try to refinance it. So that means that I want to change that current loan to a good term. So that means we call it in our industry is rate and term refinance, meaning I'm not getting money out. All I need to do is I have a mortgage that's already 7% term for maybe 30 years, and I would like to go and maybe today was like 6.5%, but I want to put in a fixed rate. So that means a refinancing. I'm refinancing that loan with a better term. The other type of refinancing, we call it cash out, meaning that I have equity in the house. I would like to access that equity of the house. So it depends on the states. Like, for example, here in Texas, the maximum you can get is about 80% of the value of the house. So when that comes to me, I said, okay, well, Mr. or Mrs. Borrower, how much you own on the house with the first mortgage? And then we're going to subtract from that value coming in as a appraised value minus times the 80%. And that's how much would be paid. And that's how much you get out of that. So if you have a house that's $100,000, for example, value, appraised value, and 80% out of that would be 80,000. So you can access only to 80,000 out of that. How much is your loan? Let's say 20,000. Okay, now you have $60,000 that you can have access equity of that. So that's going to be the we call it cash refinance. So I mean, the refinancing on those, it's a good tool, especially if you want to looking for a debt consolidation. Especially a lot of people don't think about that because remember, a mortgage is considered as debt. So now when I already have a lot of debts like student loans, I have a credit card debts, store credits, all those added together, you have every single month you make a payment, minimum payment on those debts. So if you would be able to look at all these debts and see how much the interest rate on those. And if you're looking at it and say, okay, if I have access to the equity in the house and I'm getting it for 7%, would that be cheaper than paying my credit card debt and I'm paying double digits on those?
Mm-hmm. Mm-hmm.
So that's the way when they come to me, I can have to run the numbers and have to make sense because I actually I did it January of actually that would be a year for him that I closed on that on his loan. That gentleman he got a divorce, so he had two homes that he had to split, and he's still paying mortgages on these two homes, in addition to all the costs associated with the divorce and his credit cards. So he came to me, I presented, and he's looking for, excuse me, HELOC, which is type of a loan that comes in as a secondary lien, which is home equity line of credit. and he wants to get access equity to pay off all his debts. So now I ran the numbers. I said, you cannot afford it. You're already paying two mortgages. Now I'm going to add a third mortgage for you to do that. You cannot afford. Your income does not afford all these payments. His house was, I believe, 4.5, 4.25 interest rate when he has on that loan. So I said, you cannot afford the HELOC. So what I did is, okay, let me think something different completely. I ran through all his debts. I said, okay, how much are you paying every single month? And he used to pay about $5,000 between all the mortgages and all the debts. I said, okay, let's look at it this way. If we access the equity on the house that you already have in right now, and I'm going to change that because we're going to refinance it. So you're not going to get the 4.5 interest term. I'm going to put you in a new interest rate. And happened to be at that time, I believe it was like about 7.25. And of course, at the very first discussion, no, I don't want to move from 4 to a 7. Okay, it doesn't make sense, yes. But when I run the numbers and I told him, okay, you already paid $5,000 a month right now. If I consolidate all that and you have only one mortgage paying and you pay everything and you save $1,500 a month, would that make sense to you? Kind of like, yeah, it makes sense. Well, because I only have one payment and I pay $3,500 a month. And I pay all the debts from my cash out and I only have one payment. Yes, I put you in a high rate term, but you only have one payment. You have that $1,500 the extra now, you can start accelerating and paying that mortgage early. So goes into just run the numbers and see where is the benefit to the client, where is the benefit to them. Otherwise, I mean, you don't have to put them in a loan. It doesn't make sense.
Mm-hmm. Mm-hmm. I was lucky in getting my loan right now. I was able to get 5.3. So I know
Mhm.
that the mortgage, there's points where you can get a better interest rate than what most people are getting right now. So can you explain that a little bit?
The market is right now is volatile. The reason for that is a lot of people has a misconception between the Fed's interest rate and the mortgage interest rate. They're not connected to each other. The Fed's interest rate, which is currently between 4.25, 4.5, this is on the day-to-day financing. If your bank goes to a
Mm-hmm.
bank and try to get loan from the bank, that's going to be the interest rate. That's what the Fed control. If you're looking at the mortgage is a long-term refinancing. So if I am an investor and I go in and I see, okay, well, if the Feds can give me 4% and I can put this in a safe investment tool, would I keep it there because it's safe? And a lot of people say yes. So that's what it is. That's what the bond is. Bond is a safe mechanism of investment. If it goes down, then the other way it's going to go is the interest rate of the mortgage. So if you're looking at it, say, okay, well, would the yield of the bonds, if it goes up, would the interest rate goes down? No, that's going to be the other effect because we're looking at the interest rate of the if the yield is of the yield. If the yields start going into 3% and 2%, then yes, now the interest rate of the mortgage is going to start follows through because what you're looking for is what is the safe? Should I take risk on those or not? Right now, if I'm not getting any, like I'm getting 1% of a safe, should I go and start investing on the interest? So that's why what's happened is going in on that direction. So we already have one full point since September of last year, since it's Fed cut the interest rate. But however, what happened to the mortgage rate? Mortgage rate is still stubborn, still going the other direction. The expectation that it's going to go down, but it's not. So what is the interest rate and how we be able to do it? There's a lot of option that you can go and do it. Normally, lenders, what they're looking for is they can give concessions or points. We call it discount points. Meaning is if I'm a borrower, I'm going into a lender, I said, okay, what is the current interest rate right now? Basically. and they say, okay, what's like 7 1/8. Okay, how much you would give me 6.5%. Then I can do the calculation. I said, okay, I can give you that with certain points. So what is certain points? That means the money as a borrower, I'll pay it to the lender so I can get that rate. Those will be calculated based on, like we said, how risky is that file. So one person can get the same rate but pay less because their file is not risky. Because normally when the lender or the investor price a loan, they're looking at it and say, okay, how much are they putting down payment? How much the credit score? How much reserve? There's a lot of things they can look at it and the start even give you incentive, meaning good and a good pricing, or kind of like penalize you. So rather than give you a let's say 6.5, you can go in 6.75. Why? Because they find something that they're going to get penalized for that. Or somebody comes, oh yeah, he's already between 750 to 800 credit score. Okay, they give him a credit for that. So now you're going into the lower interest rate.
That's kind of interesting. And I understood that just coming out of my loan, buying the points that I could have bought more points, giving more money in. And we looked at that and we looked at how, what we had, because I ended up, my son, I have one of his school loans on my credit that I'm paying for. So he co-signed with me because of that. And it was, we tossed up, do we pay off the loan? Do we pay off the car? Do we pay off, what do we pay off? And they come up with, well, you can buy the points in this amount, but it wasn't going to make enough difference for anything to bring down. So we just went ahead and paid the car loan that he had off. That's what we chose to do, which was the best thing for him because now he has no interest rate on that car loan. So
That's true. I mean, that's what you need to do, kind of like the analysis of the number, because it's like, look at it as an investment. Should I pay the money now? And if I pay it now, how much is it would be on the long run?
mhm.
Because that's when we comes in and we have people that already have the money. I said, okay, I can pay that. It's like, okay, so are you willing to pay that now? Okay, and get a point, but I'm gonna stay in the house for 5 years. Okay, let's look at it and see how much the house will appreciate in 5 years, how much you saved with that extra money that you bought point for, and would that make sense for you? So that comes in with the analysis of that we provide to our client. Is that a savvy decision to make or not?
Yeah, and I know there was a lot of things that, a lot of the hoops that I had to jump through. And that one was one about the amount the car was worth and the other small little credit card loans that were out there, just literally $10 here or there. But that needed to be paid off. They needed to show that all the credit was clear so that the credit debt ratio was better for the loan process.
That's correct. Normally, when a client comes to me and have the idea that I want to sit and discuss if I can be able to buy a house or not. So we're looking at we're looking at the whole entire file as financial, and we're looking at it, so, okay, first thing I'll need to see, okay, how much income are you making? All right. Once I know how much income, now we can look for the credit. Okay, how much debt are you carrying? How much the whole entire debt, and how much are you paying monthly? And then we'll start looking and see, okay, what is your credit score? Do you have any derogatory effect on your credit? Okay, do we have any collections? Do we have any bankruptcies, foreclosure, anything like that? Then we start looking at, said, okay, well, what is your assets? Meaning, how much money do you have in the bank? Okay, it doesn't mean all the money that you can have in the bank is the one that you're going to use it in the transaction. We're looking for some money that we call them reserve, meaning that I want to see this money sitting in the bank, but you're not going to use it in the transaction. This is something that to tell me that this person is savvy enough that he's already saving money. So that's why we have the money sitting there. And that's give the underwriter a clue that this person is, in case of something happen, like for us, our self-employed people, that if something happened and we have a low month or so, then I have money to pay the mortgage. So that's what they're looking for. Once we add all this together, now we're looking at, okay, how much you can afford. Technically, we're looking for that 30% of your income should be toward your mortgage payment. So what is the mortgage payment? Well, mortgage payment will be the principal, which is the amount that I am getting a loan from, the interest rate. So I'm going to pay interest on that. And then I'm going to have to pay to other things, which is the taxes and insurance, and sometimes HOA. So those are going to be the monthly payments. So I'm going to take that amount and compare it to your gross income. That's what we can come up with something that's why you called it the debt to income ratio. Normally, we want to be within the safe ratio. Why the safe ratio? There's a guidelines for the Fannie and Freddie and FHA. Normally, between 40 to 50%. You don't want to pass the 50%. 50% is kind of like, is way high, okay? But when we're talking about that, this is combined debt, not just the mortgage. Combine the debt as far as car payments, student loans, child support, credit cards, all this debt together. In addition to the mortgage, that's why we're going to call it debt to income ratio. Technically, you don't want to go above the 40%. If you start going above to the 45, you still can get the file approved, but hey, this is what becomes my advice to my clients. Remember, you paying the mortgage, that mortgage, two things is going to be fixed if you got a fixed interest rate. Your principal and your interest, they're not changing for the life of the loan. However, taxes and insurance is always going to go up. You have to put that in consideration because you know that the income doesn't increase the same percentage of the taxes and insurance. So you want to put in consideration that at one point you don't want to get and you find out yourself that your mortgage payment is more than the 40%, or at least the mortgage payment considered to the income within the we said 30%, because we need to leave room for your other debts. And then other things that people always forget about it. Buying a house is not just the money to buy the house and that's it, and paying the mortgage on a monthly basis. There is a cost associated with maintaining the house. Because remember, the houses appreciate. So, and that's what I used to tell my client that they're trying to buy the house first time. I said, okay, if you wake up in the morning and your water heater is not working, if you're renting, guess what? You're going to pick up the landlord and say, okay, come and fix it. Okay, if you are owning a house, what's going to happen? You're going to call yourself. I need to fix that water heater. Where is the money going to come from?
Dig in your
Can I use a
pocket.
credit card? Or you have a reserve. And that's what the reserve is going to come to use it for that. So that's, you need to keep yourself up to kind of up to the speed of what is the cost to maintain a house. So that's another thing that we advise our client is what it takes to go buy a house, and not just
Right.
on getting that, because you can be pre-approved and you go and start buying a house and you get into the house and then 2, 3, 4, 5 years as you find your permit is way high and people comes in and said, I cannot afford it. What happened? We already qualified for that. Well, I lost my job and I've been 2, 3, 4, 6 months without paying it. Okay. Do you have a reserve to pay for it? Did you contact the lender? Lenders don't like to foreclose. There's a lot of hassle for that. So technically what they're looking for is be in communication with your lender. They will be able to assist you and help you, because bottom line is they need to get the payment. That's how they make the money. So if you find out you're not paying it, go and tell them, hey, I already have hardship. Help me out so I can be able to extend that. And they're willing to do it.
Yeah, I just had a friend that just did that. She lost her job just in that same scenario, and so she contacted her lender, and they just extended it out the end, just another, I don't know, a year or something to that effect, or another few months or something. But yeah, I think that a lot of people don't realize that you can get a hold of the lender and that lenders don't like to foreclose, because what are they doing with the house? They have to sell that house, and they can't sell it for as much as the house should sell for if you put it on the market.
I mean, they have to understand that the investors are not in the business to sell homes.
Right.
They're in the
Right.
business of making money from the loan. That's what they're in the
Hmm.
business of. So
Yeah.
when something like that happens, they're willing to help and assist their clients.
So if I sent you a client who's going to need to refinance their home, what are the first steps and things that you're going to go through with them?
First of all, I do kind of like a consultation. Try to find out what is the reason for the refinancing. Would it make sense to do it or not? And then they start filling the application. Once they fill the application, I would like to go and verify the numbers, because there is two things when you fill. I mean, we can give me the numbers over the phone and I'll tell you, oh yeah, you pre-qualified. Meaning, according to what you're saying, you pre-qualified. To go to the next step, which is pre-approved, meaning that I need to validate the income. I need to see the bank statements. I need to run your credit report. I want to be sure that all those numbers that you state is true. Once we get to that point that we can go and say, okay, well, now you're already pre-approved. Let's go and find out the lender that we can negotiate to give you the best deal. So
So there,
technically,
then
you start
go ahead.
application, so you can run the numbers and find out what is the reason for that.
Yeah, and so that's when you figure out what type of loan that they can get for this. Okay.
That's
So
correct.
it's not just a regular, I mean, it's not just refinance and stay here. You are going to go out and do the very best for them and find the best deal for them.
For them, yeah, that fit
Okay.
the situation. Yeah, because
Yep.
it could be. I mean, we can have a. They have a product. We have a home equity conversion mortgage. That's for the people that 62 and above. Can they access equity on the house? Sure, they can. Would it for everybody? No, it's not. So we're gonna have to review and then file and say, okay, will that fit for you? Yes, it will fit. Like that person that I was discussing it with you earlier, he came to me as a HELOC. Well, that's another loan of accessing equity in the house, but they cannot afford it. So we went up to another type of a loan, which is cash out. So end up as this one. So that when they come, that's what we're looking for, is what is the best option available for them. And then once I find out two or three lenders, now it's my step to go and start negotiating, because it doesn't matter. I mean, I'm looking for is that's when I do the interview with my client is what you're looking for. You just want to lower the interest rate. That's it. Okay. Or are you looking for how much the mortgage payment would be? You want to reduce that, or you're comfortable if it goes up a little bit, but with lower closing costs, or the other way around. So that's why I need to know what are they looking for, so I can be able to fit them on the right product.
And that's good. So,
Mhm.
so kind of explain to me the types of loans, like the ARM and the other aspects that people go in.
Okay, when we discuss about loans, we can discuss them in two main criteria. There is what we call them the conventional loans, or the qualified mortgage loans in our terminology. Those will be the ones that comes in as a Fannie and Freddie, which is a conventional, or it could be the government loans. When I say government loans, it could be like the FHA, the VA, USDA. So those type we consider them as a conforming loans. For example, if you're coming to me as a self-employed and you want to go and get one of these loans, the conventional loan, the first thing I said, okay, give me the last 2 years of your tax return. That's because I'm looking for 2 years as a self-employed. We know that they have peaks and valleys in their business. So I need to find out how much the average they're making within a month. If you comes in and say, okay, well, but my tax return is not going to show exactly how much my business is bringing, then we're going to go and say, okay, we have type of loans that can go with that route. Could be I'm looking at your 1099, or I'm looking at your bank statements, or I'm looking at DSCR, for example, if you're looking for investment. There's a lot of type of loans that goes in. Those we consider them as a non-conforming loans, meaning they don't go exactly with the criteria of Fannie and Freddie, because the lenders and the investors are the one that producing these loans. Some of them they might abide by the rules, but they have their own guidelines as well. So once I start stepping out of that, there's a lot of type of loans that can use under those criteria. It doesn't mean that the conventional of the qualified mortgage type of loans only these two. There's a lot of them underneath of that as well, like for the down payment assistance programs or that Fannie and Freddie provide, and the same thing with FHA. But if you're looking at it without getting into details of a lot of loans, it's like between two, either conforming type or non-conforming type. Technically, the non-conforming type, like we said, the guidelines is different. The tendency of the interest rate is higher, because now I'm talking about those loans are not, they're kind of like high risk, and the investor knows about it. So that's why they put their own guidelines. You find out that they have a tendency of high down payments. Like we said, with FHA, normally it's 3.5%. You can jump in on a home, and normally we get that, or you can get 3% for example, for conventional, or if you can get into one that FHA and they pay you, I mean not pay you, I mean the lender can give you those the down payment amounts, then you technically buying the house with no closing cash to close at the end when you go in and sign the paper, because they give you all those money up front. There is price for it. That's why I always tell my clients, there's nothing free. You pay for it one way or another. Okay, they can either put you in a limit for between 3, 5, or 7 years as a forgivable, for example. It depends on the type of the loan, or they can give you the high interest rate. So it's kind of like a lot of type of loans that can get into that.
Yeah. So that's a lot of information, and we're getting ready to come to the close right now. Is how, so when somebody wants to get more information from you, or they want to talk with you about possibly working with you, how will they be able to get a hold of you, George?
I can give you my contact information. I have a normally I give them my schedule, because I have a lot of appointments. So I kind of like put it in public, because whoever is can comes in and get that appointment. And once we appointment, yeah, we discuss it and see if that's something that worth to put information in. Go ahead and start fill the application, and then we'll take it from there. And we look at it and see what is the best available option for them.
Okay, so just so our viewers know, all of George's information is below, and so you can look up all of his contact information below. Is there one form of that contact that's better than another, George?
I mean, better probably would be the email. Text you can do it, but I might not run in, because emails, I mean, I have certain time that I dedicated for running the emails, because I'm always in meetings, or sometimes I'm not sitting in front of my computer, but I have a dedicated time to review on my emails.
Okay, and what is your email?
My email is george.agban. I guess, do you want me to spell last name? It's A as in apple, G as in George, B as in boy, A as in apple, N as in Nancy, at jdagban.com. George.agban@jdagban.com.
So very good. Good. That's great information. And so for our viewers, I'm a certified divorce coach, meaning that I'm trained in divorce and its complexities. I specialize in high conflict divorce. My late husband, my dad, and myself went through a high conflict situation in our lives. So not only do I understand what you're going through firsthand, I also have been taught to understand divorce. So if you're wanting to reach me, you can reach me through my email at coachtinalyn@gmail.com. That's CoachTinaLynn@gmail.com. And my website is divorcecoachspecialist.com. You can also find me on social media on Facebook under Tina Lynn Huggins, Huggins, on LinkedIn under Tina Huggins. on Instagram under Divorce Coach Tina Lynn, and TikTok under Divorce Tina. So I usually ask this. So what of all the information that you could give our viewers today, what do you feel is the most important advice you can give right now?
The best time to buy a house, I would say it's now, because what you're looking for is don't tie yourself to the media, don't tie yourself to the interest rate, tie yourself as your needs. Are you ready to jump in to buy a house or not? The sooner the better, because there's a lot of variables, and the best thing is go and sit with your mortgage advisor and they will set you a path to the home ownership, because it can take you forever and you decided I'm not ready, and by the time you meet with them, time already passed, and then they start pointing at some other things that you need to get ready for it, and it's too late.
Yeah, yeah. So my advice to our viewers is a lot of you go through your divorce process, and many of you have been in a financial abusive situation. Getting to this point where the mortgage is part of it means that you're coming to the end of that divorce. So that's very, very good for you to get to this point and be able to get this information from George. So because we talk about that type of violence. If you are in a violent situation right now, please call 911 or in the UK 999 and get the police there. Press charges. Keep those charges in place. If you drop those charges, the next point in your relationship will be much worse than what you've dealt with. That is your key out of the relationship. If you or somebody you know is involved in a domestic violence situation, please call a domestic violence hotline at 800-799-7233. That number again is 800-799-7233. Please like, comment, and share this information to help others. Thank you so much, George, for coming on and explaining the complexities of mortgage for us.
Thank you so much for inviting me. I appreciate it.
Thank you, and we'll see you all next time.
Buddy, you take care.